So I remember last time that we spoke about the accounting financials, the financials that we submit, and if I remember correctly, you indicated that it's made up of three documents, sorry, three sections. One, for a better word, is that thing called the balance sheet, the cash statement, and the income statement. Is that correct?
That's correct. Yeah.
Yeah. So, and if I remember correctly, you said that 80% of people, just basically use their documents just for tax season, to pay it from that point of view. But there is so much more that you can use your financials for.
Oh yeah, definitely. And that 80% that I was talking about doesn't necessarily refer only to structured companies or CCs. I refer to sole proprietors. That's part of that. The percentage I use, So a lot of sole proprietors, their books aren't even that formalized. To be honest.
It's like on a matchbox.
Yeah, like in a napkin or an empty cement bag or something.
Or they take it out of their bucket and give you in a plastic bag, and there is all the there's all the slips.
Got a lot of those.
You got to go through that specific thing. What did you buy? Yeah. Oh no, I think I can't remember.
Yeah, it's exactly that. Yeah.
So I remember you said that the three sections in an annual financial statement, being the balance sheet, the cash flow statement, and the income statement, they work together as one document to give you a story of that business, but they can also be read independently of each other. Correct? So that's what you said.
Correct. Yeah.
So I want to just delve a little bit into get a better understanding of the balance sheet. Exactly. And I think over our conversations we'll get into the other ones as well. But I want to just delve into the balance sheet. Is there by any chance, you said that you got the three documents and they talk to it. Is there one more important than the other, or not necessarily?
I don't think there's a one that's more important than the other. Your income statement tells you the story about your profits and losses for a period of time. It gives you a net profit for the year or for the period. It contains your tax liability in essence. Your balance sheet needs the info that comes out of the income statement so that it can either add to the owner's equity or subtract from the owner's equity, because that's your reserve portion. So the balance sheet can't be read on its own without having an income statement.
Yeah.
Then there's a statement that we probably not going to talk about at all, and that's your changes in equity statement. But that's the statement that basically links the prior year reserves to the current year reserves. But you need that statement, but it's not as important at the moment. But it's a link.
Yeah.
It's a link between the income statement and the balance sheet. But the balance sheet can probably stand on its own, but you need the reserve. So the income statement, balance sheet, those two, I think is the most important two. The cash flow statement is a vital part of decision making. It shows where you've spent money.
Yeah.
If you're uncertain of what did I do with all my cash that I've generated.
A lot of our viewers are going, what is cash?
Yeah.
Where is it? What's this?
Yeah. So, but your main interacting statements would be your profit and loss or income statement and your balance sheet.
Yeah. So in essence, what I'm understanding you, and also from my own experience, is that you can read them independently. You can look at them independently. However, to get a better and full story, you need to read them all together as one document.
No, exactly. Otherwise, your framework, and I'll keep talking about a framework, is not gonna work.
Yeah, your story is not complete.
Yes,
it's a chapter in a story.
Yes.
So when we, and let's delve a little bit more deeper into the balance sheet. last time, and you did mention this, you mentioned the accounting equation, of your assets, something that we own, your liabilities, what we owe on that asset, and owner's equity. Just expand a little bit deeper into that specific and how it relates to the balance sheet.
Look, your equation is made up of we call it a tier account. There must be balance.
Yeah,
it's like a yin and yang. There's one. You need a balance, and the balance sheet basically. They don't call it a balance sheet. Actually, they now call it a statement of financial position. But the essence is it's a balance sheet. You balance what your assets that you have has been represented either by liabilities or by owner's equity.
Okay.
So your balance sheet will always be on top of the list, and it will list everything that's either tangible or not tangible. And it needs to be balanced by how did you get it? How did you buy your assets? How did you come in, how do you have debtors? How do you have stock or vehicles on your balance sheet? And that'll be, how did I finance it?
Yeah.
On the bottom side.
Yes.
You'll have liabilities, a bank overdraft maybe. Or you might have none of those and only the owner has put all the money in, or the business has grown to such an extent that the owner's equity covers all the assets that's listed in your balance sheet.
Mm-hmm.
So a traditional balance sheet will have your assets on top, it'll have your owner's equity in the middle, and your liabilities on the bottom.
Yeah. And if I'm not mistaken, so yes, we talk about the way that I looked at it is that the owner's assets equals liabilities, owner's equity equals assets less liabilities.
Correct.
Owner's equity, in other words, what I as a business owner owns of that business is equal to the assets that the business has less the liabilities. And we used the example again, in our last conversation, to make sure that I got it right, is that I've got a vehicle, which is an asset of 100,000 Rand. I own on that vehicle 50,000. So it's the asset less the liability, which is the 50,000. So assets of 100 less liabilities of 50,000 means that I, as an owner's equity, or what I own, is 50,000 Rand.
Correct.
On a piece of paper.
Correct.
But but again, like we said, all lumped together.
All lumped together, yeah.
And the other way that I looked at a balance sheet, or what did you say? A
statement of financial positions.
Yes. And I recall that a balance sheet, you said, was a snapshot in time.
Yes.
So at a point in time, we say, let's take a snapshot of your business, and this is how your business looks from what it owes, what it owns, what it owns, and what it owns in assets, and what it owes in terms of liabilities.
Yes.
From that point of view, that's the snapshot in time, and then that is the health, one for a better word, of your business.
Of the business,
and as you said, as part of that, your other statements talk into that specific thing as well.
Yes.
But when I was learning and going through, I always try and dumb things down to as low as possible for my brain to take in. But when you look at a balance sheet, even though the accounting equation has 3 parts, the balance sheet keeps those in 2 parts. And what I mean by that is that like you said, you have an asset as a component in your balance sheet, but owner's equity is part of the liability, because the company and what people don't understand is a company is a juristic person.
Yeah.
It's on its own. You as an owner are separate to the business,
yes.
even though you're one in this. Everybody sees, you one
exactly.
in the, but they're a juristic person.
So you can have a positive or a negative owner's equity.
Correct. So in other words, the owner's equity is what I owe you I'm the business.
Yeah.
You're the owner of the business. I'm a juristic person, but therefore I owe you the money
Yeah.
as the business.
And therefore it's the individuals.
Yes, and therefore if I owe you the money, then on the balance sheet, it must show as owner's equity as a liability.
Yeah.
So therefore
For the business.
For the business.
Yeah.
So the balance sheet theoretically is an asset and a liability. And you balance the equation by putting the money into the owner's equity.
That's good.
To say, okay, right, this is what's left, dump it into the owner's equity, and that's what we as the owner.
That's what the owner is entitled to.
The owner is entitled to, which is a completely different thing.
But you can have a negative side of it as well.
Correct.
If the owner takes too much, or the business is not performing, goes into losses.
Yes.
Or, it'll show that the owner might have to put in money to save this business.
Mm-hmm.
And that's where the negative owner's equity comes into play, where liabilities is more than the assets.
Yep.
To balance it, the owner
has to put in the difference.
To foot the bill.
Correct. So to bring that in again into your personal life, if you want to put it that way, because I remember I mentioned last time is that it doesn't matter if it's in business or in your personal life, you still got a financial statements or a financial review is in that specific thing. So again, we go back to just in simple terms. In simple terms, the balance sheet is your assets less your liabilities. And let's use that one in our life. So all my assets, what I own in my life, my house, my cars, my furniture and everything, we put on the one side in the assets. So there it is, all my cash in the bank, et cetera, and that how much is worth, let's say R1 million, just as an example. On the liability side is that, okay, so now I've got a house, I've got my car, and generally those are the ones that get financed. Isn't that your furniture? Hopefully, I wouldn't say hopefully, some people finance it, but and of that, let's say that I finance my house, my asset side is R1 million, but I owe the bank 500,000 rand. So I owe 500,000 rand. So therefore, my true worth in my life is 500,000 rand.
Correct.
Isn't that so?
Exactly the same thing. Yeah.
The only difference is in that specific equation, and I'm using it as my personal thing, I'm my own owner. So therefore, my owner's equity is my bottom line. Whereas in a business, it balances with the owner's equity by saying, we owe you the 500,000. Me as the business owes you the 500,000. And it's a bit, once you get once you get your head around the accounting equation, it's a simple equation. It's not a difficult thing. And you read it with those eyes onto the balance sheet, it kind of like makes things pretty simple.
Look, there's a few rules and a few taxes involved when you want your money back. But that's a different story. That's a different conversation.
Correct, 100%.
But what you using the example in your personal life towards a business, it's exactly the same. So even if you're a sole proprietor, it'll be the same. You'll have a business, even if it's in your own name. You don't have a company or something that's got a structure. That business has a loan account or a capital account, as they call it. And that's either positive, it means it's yours. When you liquidate the whole thing and you sell everything, you get a capital account back to you. The money goes into your bank. Or that capital account might be in deficit. That means that the assets that you've got in there is not worth as much as the liabilities or the people that you owe for that business. And you might have to pay in.
Yeah.
Exactly the same scenario.
Yeah.
Just that a company is a juristic person on its own. It kind of ring fences some risk. It's different to a sole proprietor, where the owner then takes he's got all the risk. If there's a company involved, there's the directors are responsible and so on. But it's an entity on its own that has to be dealt with on its own.
That's why, and again, maybe going off a little bit off track on that specific thing. That's why, we keep talking about this juristic person, and people might not understand exactly what that means, but it's an entity on its own, independent of you as an owner.
Yes.
And like you point out, is that the owner might have run the business as a director. So I'm directing the company. There's risk on those directors, but the responsibility lies still with theoretically the company as the juristic person.
Yes.
It's not as simple as that,
No,
but that's where it is. And that is why, and the point I was trying to make is that if you're going for a loan, you have to sign sureties.
Correct.
Because the contracting party is a juristic person, aka the company and the supplier. But if something goes wrong, they want somebody else to underpin that specific thing.
They
So
need
you sign
somebody to be contacted.
Sign that your life away. Put your house on the.
And in essence that you've just all said or touched on regarding surety. The better your story is, we're talking about the story now, for your company or for your business, the less reliant somebody will be on your personal surety or the surety of directors.
Mm-hmm.
If the company or the business shows a history of profits, a history of a positive financial position on the balance sheet, they'll have less need for you as an individual to sign sureties for supplier accounts or for bank overdrafts, etc.
So if I understand you correctly, I know we spoke about the story. That story, and like we said, it tells you the position of your company.
Yes.
Because when I'm going for a loan, I have to tell this guy a story. And we spoke about independent people telling you that story. So obviously, the better your story is, it's not the better the story is, but your books are good, your story is better. Therefore, the person who's reading that story gets a better feeling for that story in that company, and therefore has to say, well, do you know what? Your story tells me great. You've got good assets. Your liabilities are low. You've been, preserving your cash, your owner's equity. You're solid. I don't have to rely on you as a third party to underpin that balance sheet or that company with your own
personal
balance sheet,
assets
your own balance sheet to do that specific thing.
Yeah,
so that's that. I think you said that 80% of people tend to use that as just for the tax benefits, and I think that's what I learned. I said I realized that and I spoke last time. Is that once you understand these pieces of paper, it has to happen. So just make use of those pieces of paper and make sure that your position and your story is good on that piece of paper, because there is going to come a time, or there's most likely going to come a time, that you have to tell your story to somebody. Like you said last time, the CV, I've got to give it to somebody. So just spend a bit of time in understanding that specific thing, understanding your balance sheet, understanding all the different pieces of paper. It's not difficult as much as it seems to be. And that's what I learned from that at the end of the day. Said if you just sit down and understand those small little three pieces of paper at the end of the day, with me being, the balance sheet being, for me, the balance sheet was the most important, even though you said they're independent of each other. But I tend to look at the balance sheet more than anything else and feeding into that specific thing, and then try and strengthen the balance sheet by saying, okay, let's do this, let's do that. We'll get into it. I learned that do I expense the asset, or do I stick it as a write it off on the income statement, or do I stick it into the balance sheet, because it tells a completely different story on how you do that specific thing. But you can't do that unless you understand what those pieces of paper you're doing it, and having a conversation with your accountant and your auditor at the end of the day.
Yeah, I think a lot of people struggle with the idea of whether or not to, do I formalize my business do I put in proper financial records and accounts and a balance sheet, income statement, cash flow? Do I do that, or do I just carry on day to day? Look what's in the bank and what can I spend? Cost of living, that kind of thing. You have to make the decision on what you need to do, because it's a conscious decision that you have to go into.
Yeah.
The minute that you realize that you have to write your CV for your business, that becomes an important thing, and how you treat expenses or assets or or future contracts that you go into. How do you treat it, and how is it going to reflect on your business, on your balance sheet, on your income statement? And it's all, I suppose, got to do with a bit of education or a bit of understanding of the financial situation and environment that you get yourself into.
Yeah, a lot
especially startup businesses. I think it's very difficult for a startup business to get a bank overdraft or get financing from a bank, or they might just need that little bit of help just to get that asset that they need to make it fly.
Yeah.
But the history or the CV isn't in place to get that,
And you said that, so compiling your balance sheet is let me take it a different way, is that you said that you've got a small little business, a sole proprietor doesn't necessarily, I mean, we all have a bank account. Well, most of us, drug dealers might not, because they deal in cash. We all have expenses, and those expenses either you're taking cash out of the bank to pay for it, or you're buying it on credit, or whatever it is. But we all have those fundamentals in place, isn't that so? And from what I understand, to go from those it's not fundamentals, but the basics things you do anyway, you're just literally lifting that up and putting it in to tell your story, isn't that so? So the leap from this, like I'm putting words in your mouth, informal process, it's not an informal process, you've got to do it, to the formalized process, it's not that far. It's just a bit of structuring and saying, because each month we got an income, each month we got an expense, isn't that so? And then it's just a matter of compiling that on a month-to-month basis.
I think you'll have a lot of sole proprietors that they pay their kids' school fees and their supplier out of the same bank account. They only have one bank account. And that's not understanding the worth of what your business is, because
it's you're creating a false.
You think that your expenses is school fees and groceries, but it's not. I always tell somebody, if you want to have a business, have a business. It needs to have its own bank account. It needs to be independent of whatever is personal in your life.
Yeah, so when they say they don't even draw their own salary from a business. Meanwhile, you've paid for the school fees, you've done this, you've done that. Exactly. Well, there you go.
That's your salary, and that's expense.
Yeah. So it's just sitting on a different set of eyes. So just to compile a balance sheet, how would you go about that? As being an auditor yourself and an accounting.
Look, you have to try and formalize your accounting records, at least. That's why I always say have a separate bank account for your business, so that you can write up your books, capture the data into an accounting system. There's a lot of software packages that's not expensive, but it starts there. It starts at your basics is where you start. It's your cash book. You get your income in, you get your expenses. You have to write it up monthly.
Yeah, it's not.
It goes all into a general ledger. The general ledger is a summary of the 12 months or the 6 months, depending on your time period, the transactions that's listed in the different categories of
whatever it
accounts.
Is. Yeah.
That goes into a trial balance. A trial balance is a summary of your general ledger. And the minute that you've got a trial balance, it balances out. That goes into a framework. I always talk about the framework, but there's certain frameworks that says your financials has to have either this or that framework, depending on the size of your company or the entity structure. And then the balance sheet is there. Your assets go onto your asset side of it, your liabilities, and the owner's equity is a result of the difference between the two. Obviously, your income statement goes into your reserves.
Yeah.
That reflects whether or not you as an owner has made a profit or a loss.
Yeah, and I assume that's I sit there going general ledger transactions, this, that, and my mind's already, as a small provider going, what the hell are you talking about? All that stuff. But in a simple terms is that just run a set of books.
Run a set of books.
That's it. Just your income, what you got, expenses. The much cleaner and the better that you spoke about software packages that automatically does everything from that point of view. But I assume that also as an accounting services that you do, you can also just bring me a bag of all your things and put it on the table. But time is money.
Time is money.
And therefore,
so the bigger the bag, the more expensive it is.
Yes, for me to go
the
through
neater
this.
it is, the more affordable it is.
I have to read this credit card slip that is faded in the sun.
Yeah, it's got a ketchup stain on it.
From that point of view.
That's it. So, it's... you can either get somebody to do it for you, or you can do it yourself, depending on your experience with accounts.
Good. Well, great. Thanks a lot, Jacques. Again, so just to catch up, or just to summarize, a balance sheet, which forms part of the financial statements, is basically a snapshot of your business at a point in time. The balance sheet can be read independently of the other statements, but it's better to read it as one because it'll tell you a better story. As I said, that's one chapter of 3 in the story.
Exactly.
And most importantly is that in a balance sheet, as I said, it tells you a position of your company, basically saying that it tells us what the company's assets are, what does it look like, the different type of assets, less the liabilities of the company, what we owe in the company, which in a way, and not necessarily balances to what the owner's equity is, what the company owes the owner as a liability, and the two parts need to balance.
That's
assets and liabilities have to balance. Good. Well, thanks a lot. I really appreciate your time again and teaching me.
Insight.
Yeah, 100%. I think hopefully that people have also got some sort of, or it's given me knowledge. Hope people listening in is listening as well. Thank you very much. And
pleasure.
When we meet again, we'll delve into a little bit more into the different other parts of the equation, or not other parts of the
statements.
The statements. It's the income statement and then the cash book.
I look forward to it. Thanks.
Good. Thank you very much.
Thanks.
Okay. Ciao.